Dean Dubois, thank you for really that very kind introduction. I appreciate that, and it's great to be with all of you today. And I think you can probably tell from her introduction that, and you look at this, you hang around long enough, and eventually you maybe do something halfway interesting. And it probably explains why I have these three affiliations, because it's not good enough just to kind of, like at Vermont, I still hang around as a fellow, still I'm no longer a faculty member there, but I hang around. And of course, when you retire as an emeritus professor, you're always an emeritus professor, right? So I'm the eternal emeritus professor at Cornell. But I am, professor in residence is code for retired. So I'm essentially retired, but this is how you retire when you're, basically I'm not ready to give up the ghost. So still writing, still thinking, still working with companies. And what I'd like to do with you guys today is maybe spend a little time talking about some of the thinking in this new book. It'll give you a flavor for it. By no means all of it, but it'll give you a flavor for at least some of it. And what I'd like to do today is start with, a bit about what is shareholder primacy, right? Because that's the title, right? So what is shareholder primacy? Where did it come from, right? Like, where did this idea of shareholder primacy come from as kind of a management philosophy? And then perhaps most importantly, at least from my point of view, why it must be abolished. We must absolutely abolish shareholder primacy as a management philosophy. And then, kind of the second half, that'll be most relevant to the kind of the theme of the forum, I think, is what are the implications of all this for business education, both from the standpoint of how has business education contributed to the problem over the years, and how might it change? How might we think about changing it going forward? So that's what I'd like to tackle with you today, and if you got a question or anything like that, if the spirit moves you, please feel free. I'm not proud. Okay, great to be with all of you. So let's start then with maybe a bit about the origins of this whole idea of shareholder primacy and shareholder capitalism. And it's kind of our tendency as human beings to want to be able to date things, to kind of have punctuation points in history. And so I'll glom onto this one because it's kind of a popular point in history to point to the beginning, which was the publication of Milton Friedman's famous piece in 1970. Some of you might be familiar with it. In the New York Times Magazine, the title of which was "The Social Responsibility of Business is to Increase Profits." Now, I think, if you read Milton Friedman, he probably often gets unfairly painted with simplistic thinking. He actually thought in a pretty complicated and interesting way about economic freedom. And he wasn't just about the idea that business is about increasing profits, but he still published this with this title. And that was kind of the core message, which I think set the tone in the 70s, because I was in college at the time, that really, this sort of purpose of business is to make as much money as you possibly can. That's why business exists. And it kind of was, the zeitgeist of the times were, you had the end of the Vietnam War, you had, especially in the early 70s then, kind of the Arab oil embargo and stagflation. It was kind of like now, right? It was like really sort of yeasty times, right? And so this notion sort of got thrown into the mix, and it took hold, right? Because everything was up for grabs at that stage of the game. And as time wore on, more things sort of came in that seeded in underneath the idea that maximizing profits was the purpose of business. Starting, in the mid-70s, people familiar with this idea of agency theory? Probably not so much, huh? So, it was the sort of the original piece came out in the mid-70s by Jensen and Meckling in a very sort of famous academic piece now called The Theory of the Firm. But the basic gist of it was that, you have principals which they assume to be owners of companies, and they assume that to be the shareholders, even though that's a contestable fact at this point. We'll talk more about that. And then agents, which in their mind were executives, managers, and so forth of the companies, and that there was an inherent conflict between these two, because agents, so the theory goes, are inherently kind of self-interested, kind of self-interested nest featherers that aren't necessarily going to do the work that would be important in order to maximize the value for the principals. So there's a conflict of interest, and the best way, or at least one of the ways, among others, to address that is to tie compensation to those principles, to stock price, or to those agents to the stock price. So hence kind of connecting CEO compensation to stock price. One of the things that really took off, starting in the 80s, and we'll talk a little bit more about that. And that then kind of unleashed a flurry, starting in the late 70s and into the 80s, of kind of looking at companies as undervalued assets, kind of the M&A game and the takeover game, and the rise of so-called shareholder power, right? All of this sort of transpired in that decade leading up to the 80s. And during the 80s, probably the best expression of the time was Michael Douglas's famous quote, "Greed is good," from the movie Wall Street. And this was, of course, aided and abetted on the political front by the rise of kind of neoliberalism starting in the 80s with the election of Reagan and Margaret Thatcher, where perhaps the notion of market failure gave way to government failure, right? That the idea increasingly was not so much because the so-called liberal movement, which is really now the conservative movement, was focused on addressing concentration and addressing monopoly power and so forth in the early days. But that gave way over time, especially in the 80s, to more of an anti-regulation perspective, so that it's the government, drown the government in the bathtub philosophy. So these things kind of mix together to create, a philosophy of management that probably was best expressed by, some of you may have seen this book, came out maybe a year ago. Good read, I would recommend it. Probably best kind of captured by the philosophy of Jack Welch. Assume, CEO of GE in 1980, known as Neutron Jack. And, the philosophy was really one of managing earnings, sort of that really becomes less the issue. It's really about not so much the businesses as the earnings. It's about being number one or number two in every business. That resulted in, GE had always been kind of an R&D company, kind of building value from, kind of internal development within the company. Increasingly became kind of an M&A company, thousands of acquisitions and then sales. Managing many of those companies that they owned through downsizing, outsourcing, and offshoring as a way of kind of short-term value creation. Focusing on hitting quarterly earnings growth as the primary purpose and the set of targets for managers. Stock buybacks then came back into fashion again. They had been prohibited for a long time, right, after the Great Depression. But the SEC sort of allowed them again starting in the 80s, so GE really took maximum advantage of that. 50 billion of stock buybacks in 1 year. And the mission of the company really was consistent with what I expressed in terms of Milton Friedman, to become the most valuable company, right? That it was really about maximizing the stock price. And that worked for probably the better part of 20 years. It was a pretty good run, in the 90s and into the 2000s. But eventually it kind of gave way. You sort of hollow the company out over time. And by the late 2010s, that decade, things began to falter. Welch, had left the stage. He had new leadership now. And by the late, the decade of the 2010s, it had at one point become the least valuable company on the New York Stock Exchange, and then was kind of ignominiously broken up using the same kind of tactics, kind of takeover tactics in 2021 into 3 different companies. So it had a good run, but the net effect looks something like this from the standpoint of shareholder primacy, that prior to the 80s, less than half of all corporate profits, if you look at corporate profits, went to investors in the form of dividends and then share buybacks. But by that decade of the 2010s, that number had now ballooned to over 90%, which is where it still is, right? This, to me, is the definition of shareholder primacy. That, it's all about sort of taking the pool table, tilting it so that all the balls go into one pocket, right? That's kind of the name of the game. And that other constituencies, whether they're associated with the environment or communities or on the social side, would tend to take a back seat, or at least philosophically or theoretically, the idea that the stock price captures the societal value of the company, right? The so-called efficient markets hypothesis. The problem is that the efficient markets hypothesis has been pretty well discredited by now, right? So, as has agency theory. So many of the underpinnings of the whole notion of shareholder primacy, I think, have not worn well. But yet this still is kind of the guiding philosophy by which most corporations are run today, with increasingly devastating consequences. Because I think probably most of us would agree the last 40 years have been pretty fraught. And we're kind of living the consequences of that right now. This is a great read too. Kind of, I like the metaphor of the one-legged stool, you know, which is Ed Shambliss's way of kind of communicating this idea. So over this period of time, you know, starting in the 80s, this was also the same time that the notion of kind of sustainability began to arise, right? Kind of the term itself is a 1987 term. Before that, it was known as business and the environment. That was the buzzword. You also notice that this whole domain is characterized by buzzwords, right? I mean, just a constant proliferation of buzzwords. And oftentimes people don't really know what they mean, or they assign meaning to them, you know, and then attribute some sort of cultural attribute to them. And we're living that too, right? We're kind of living in the midst of that, rather than really understanding the underlying phenomenon, which is the most important thing. But sustainability over this period of time, as it arose, you know, because government had sort of backed away from the scene, and it didn't matter whether it was Republicans or Democrats. Both Reagan and Clinton expressed the same view, right, that the era of big government is over. Solutions were not going to come from the government through government policy. The government was sort of backing away from the stage. So if we were going to address environmental and social issues, it was going to be through business, right? This was the whole idea of business and sustainability. And this is most of my career, right? For me, it started in the late 80s. And I've been at it ever since, right? And for most people that worked in the business and sustainability space, the idea was how to translate the challenges, kind of social challenges of inequality or poverty, environmental challenges, whatever they might be, into strategies for business that could actually yield financial gain, right? The idea of sustainable value. A win-win, right? That was really the key, right, to kind of the whole rise of the sustainable business movement. And it was premised on, I think, one underlying, often unspoken sort of assumption or expectation, namely that if you're going to undertake a new initiative in a company or in a business that relates to, quote, sustainability, then, you know, you have to show the business case. And the business case is code for it can't harm, you know, quarterly earnings growth or the short-term stock price. If it does, it's not going to happen, right? That became our challenge, right? To how do we frame sustainability in a business win-win term, right? Given that that's the case, and I believe what I'm saying is a correct representation, it shouldn't come as a great surprise that most of the things that companies have done, in some cases really interesting things, but most of them have been fairly incremental, because that's what can drop to the bottom line most quickly, right? So eco-efficiency, waste reduction, emission reduction, and so forth within facilities, or at the product level, you know, maybe you think about sustainable sourcing and procurement, or you think about product take-back or product redesign for recycling and so forth. Those kinds of things are in what we think of as the green product space are what have predominated, right, over the last 20 or 30 years, whereas the more fundamental innovations, in other words, abandoning entirely inherently unsustainable technology bases in favor of new technologies, has been a much slower process, right? We just haven't seen those kinds of transformational changes as of yet. They're starting to happen, but it's kind of late, right? That had we been on the transformational path starting 20, 25 years ago when, as you mentioned, I wrote this piece called Beyond Greening Strategies for a Sustainable World, which laid out the case for this then, right? Then we probably wouldn't be where we are today. But the fact is that kind of the pressures of shareholder primacy kept us in the win-win territory, which meant we went really slow and largely incremental. The result being that here we are, right? Here's what 40 years of shareholder primacy has brought us, you know, which is some really significant environmental challenges that we face. You know, I'm just talking about the data now, whether it's biodiversity loss or whether it's rising ocean temperatures or rising world temperatures, whatever it might be. And then, you know, probably we're at a point, again, once again, of sort of peak inequality in the world. and we have our own version of that problem right here in this country. So we're sort of living the consequences, in my view, of shareholder primacy capitalism, which has been dominant now for 40 years, right? And we're at, in my view, we're at sort of a crisis point. It's time for this to change. Now, this may seem kind of daunting, right? Because it seems like, how do we shift the entire edifice of capitalism, right? It sounds like an awfully daunting kind of proposition, doesn't it? I mean, it sounds really. So part of my motivation for kind of, you know, spending time kind of writing this and thinking about it this has been about 6 years working on this, was to gain a better understanding of how we got here in the first place, which meant understanding, where did capitalism come from? How did it evolve over time? What were its fundamental principles in the beginning? You know, is there anything we can learn? You know, has it run amok before? And what I discovered was that, in fact, it has, right? That capitalism has been through at least 2 previous, what I think of as reformations, right? Where it sort of went off the rails and was pulled back over time. And I believe we're in one of those right now. We're in the 3rd capitalist reformation right now, but there's a lot we can learn from the first 2. So I want to touch a little bit on those as we go along, if that's okay. And then we'll try to tie that into to the role of business education as well. Making a little sense so far? Okay. Any issues or questions at this stage of the game? Okay, we'll keep going. So, question for you. First question, big bullet point, blue question. What was the world's first and most profitable multinational corporation? Don't read the other stuff yet. Just write it. Think about it. What was the first and most profitable multinational corporation? I mean, was it Standard Oil, you know, or GM, or yeah. Yeah, he's got it already. See, you guys are all over it. Because there's some other hints here, right? The largest corporation in world history, accounted for half of world trade at its peak. I'll reveal it in a moment. He got it right off the bat. Over 260,000 staff, you know, that were there primarily to protect the assets, and it lasted more than 200 years. And the answer, as he said, is the British East India Company. Going back to the year 1600, right? This is really the origin story of capitalism. Created in 1600, it was the original joint stock limited liability corporation, exactly the corporate form that we have today, right? Financed with private equity, with venture capital, right? And they actually called it adventure capital. It was called adventure capital back in the day. And virtually all modern day corporations in Europe or the US, almost everywhere, are structured exactly this way, the same way as the British East India Company. And there's a great book, you know, there are a number of them, but I would recommend Nick Robbins' book, The Corporation That Changed the World, if you're interested in learning a lot more about the British East India Company, because I think it's really important to understand, because this is the sort of the source code for capitalism. That it started, right, even before the British East India Company, with these kinds of joint stock, limited liability, adventure capital funded expeditions down the west coast of Africa for ivory, gold, slaves, and raiding, right? That's really what happened in the 1500s. And most of those voyages were structured this way, right? Just like it was kind of how the British East India Company structure first came about. And it's where most of the so-called explorers and discoverers, including Christopher Columbus, that's where he learned how to do it, right? He was an avid raider of West Africa before the discovery of the New World. That then model, and this is where the British East India Company came in, was extended to going east, right? To starting with the Spice Islands in the Philippines. And then for the British, once they realized they couldn't dominate, the Dutch had already kind of established dominion there, then they set their sights on India. And over a period of 300 years or so, pretty much hollowed out India, right? I mean, the Spice Islands basically were decimated by this form of what I call, you know, mercantile capitalism. But the British East India Company did the same thing to India over time, right? They began simply by buying fine garments that were made in India. India was the far superior civilization in 1600 compared to England, which was a backwater. Right? But by 1800, the roles had been completely shifted, right? Kind of reversal of fortune. India was one of the leading manufacturers in the world in 1600, and by the 1800s, it was also ran, right? There was the Industrial Revolution in Britain that came to dominate the world, and that was textiles, right? That was power looms, right? So forth. That was the steam engine, right? That brought all that about in the textile industry. And then in the Americas, with the discovery of America, settled by trading companies, right? That's how the New World was settled, right? Everyone knows that. The Virginia Company, the Massachusetts Bay Company, the British East India Company itself was involved in the settlement of North America. They were the company selling the tea for the Boston Tea Party. So that was the British East India Company. So this model came to America in the form, what was unique about the way it happened in America was first kind of seeding in kind of the slave plantation agriculture model, starting in the Caribbean with sugar, but then spreading, of course, to the American South with rice, indigo, and then later cotton. And it's that cotton that, of course, was grown that fueled the textile mills in England and in the North, So I think for us, all of us, I think it's important to realize that this is the source code for capitalism. All right, first and foremost, I think it's important to understand that. And what it looks like is something like this. This is the source code for capitalism. Its objective function, its purpose was, it was the original shareholder primacy, right? It was bullion accumulation, it was profit maximization, and it was to put everything in one pocket, the corner pocket, right? That was the purpose of the British East India Company in any way possible. Pretty much anything goes, right? Because the operating system was, as I mentioned, structurally these corporations called trading companies, but then funded with venture capital. But then it was, kind of riddled with cronyism because it was the crown and royals and nobles, along with Italian financiers and merchants, were the adventure capitalists, and it was kind of crony capitalism, because each company was granted a monopoly territory, right? So the British East India Company had no competition. They had India as a territory that was granted to them. Now they competed against, other trading companies from other countries, like the Dutch. But as far as the English were concerned, it was a monopoly grant. And their business model was extraction and subjugation, as I already suggested. Raiding and enslavement were core to this, right? That's how kind of the capitalist system arose. I think we just have to realize that this is the case. The narrative myth that gets put on it is things like, these were voyages of discovery, and they were trading companies, and it was about crusading and converting, because there's a heavy religious bent to it, kind of converting the savages to Christianity and so forth, typically goes along with this. But if you kind of lift up the hood and look at it, this is really what was going on. So this kind of model of what I call mercantile capitalism, right, this was kind of the origin story of capitalism, starting in the 17th century, really kind of came to dominate the world over that period of time, with lots of really tragic consequences, as I've just been describing, right? Kind of the environmentally, socially, resource extraction like crazy, right? You think about it, even in this country, the original idea of the trading companies was to extract as much resources as they possibly could. In India, the same thing. Why did the British build the railroads in India? Not because they were interested in kind of the sustainable development for the people, but so they could efficiently extract resources out of the interior of the country. That was the reason for the railroads. So there was resource extraction, there was social division, there was impoverishment, subjugation. This was the impact. And like has happened now continuously since then, this eventually ran into some pushback, because things that go kind of to extremes typically don't go to extremes forever. Eventually, there's pushback. And in this case, the counter movement came in the form of the Scottish Enlightenment, of all places, right? The idea that, maybe this sort of subjugative, mercantilist, kind of exploitative, monopoly kind of way of doing things maybe doesn't make a lot of sense, right? That maybe we need to think about competitive markets. Maybe we need to think about players competing against each other to actually win customers and that sort of thing, which sounds probably familiar, right? Like it's a guy named Adam Smith. And maybe we don't often think or realize that Adam Smith was the first anti-corporate radical. He hated these companies. You know, if you read his work, and I have, right? Go back and read his work, not just Wealth of Nations, but Theory of Moral Sentiments as well. And you'll realize that his motivation for writing was largely because he found what was happening abhorrent in the world. And he wanted to create a new theory of how there could actually be wealth creation for everyone, right? Not just the adventure capitalists. That was really his motivation. That through these kind of competitive markets, the so-called invisible hand, right? That we could actually grow markets, we could grow welfare, that more people could be employed, that wealth could be spread more widely. That, you know, his thinking, you know, he's often seen as the father of economics or the father of capitalism. He was neither, right? He was neither. He was a professor of moral philosophy. Economics didn't exist as a field. There was no such thing as capitalism, capitalism at the time. Capitalism is a term from the 19th century, right? But he was motivated. There was an underlying kind of moral philosophy, because that's what he was a professor of, to his thinking about the way in which a market economy would function. And, you know, he believed that business people should behave with what they called virtue, right? He was heavily influenced by the Greeks and Romans. And virtue meant, for the Greeks and Romans, pursuit of the common good, that every business person should be motivated to actually create wins for everyone. He was a stakeholder theorist. He was a stakeholder theorist. We can have a discussion about that, because I've read his work closely. We can interpret it. But that was at root, I think, what he was talking about. Now, to me, what this sort of suggests is what goes around comes around at some level, right? That there's, in the evolution of capitalism, there's a certain sense of karma, right? That, you know, every action, there's always an oppositional reaction to it. That there's a dialectic, you know, that there's a double movement, you know, as Polanyi would say, which is you have kind of an evolution and expansion of kind of liberalism, and then a reaction from the standpoint of trying to blunt its impact socially and environmentally. Or, you know, Galbraith talked about countervailing power. Jung, and I've sort of used this in my book, psychologically talked about the notion of enantiodromia. What a weird term, right? But enantiodromia means the tendency in human beings for thoughts, emotions, behaviors to reach extremes and then turn into their opposites. And I sort of see this as a pattern in the evolution of capitalism over time. That's essentially what's been going on. So in terms of the time frame we're talking about, you know, from the time that Martin Luther first sort of pounded the 95 Theses on the door of the church in 1517, and these raiding missions began, right? These sort of trading company raiding missions, to the time that Larry Fink first pounded his own version of these theses on the door, right? With the letter to CEOs telling them that the animating force should be more than just profits, right? Should be purpose. We've seen, I think, three, certainly two prior, and we're in the midst of a third kind of pushback, an antiodromia cycle on capitalism. I've just described briefly what I think the first one is. The second one, we're in the third now, right? Which leaves the second one. The second one is where I think business education really comes into play. And that's what I want to talk about next. Let me pause there for a moment, though, because I did see some heads doing this. What do you guys? Please, go ahead. What was your thinking there?
How do you explain Adam Smith's saying in Theory of Moral Sentiments, I've never done much good by those who purport to trade for the public good? It's an affectation that is not common among businessmen and something they're easily dissuaded from. It comes right after the invisible hand when he talks about legislators and government and smart intellectuals can't really tell people how to manage their money. They know how to manage it better and know what ends it's supposed to go to. How do you make him, him into some socialist out of that?
I don't see him as a socialist. I mean, I do think he was talking about market capitalism is what he's talking about.
About mercantilism.
He was critiquing mercantilism.
He was critiquing mercantilism.
Absolutely.
Absolutely.
Yeah.
That's my
Then
point.
how do you get him to be a stakeholder type?
Oh, because he believed, if you read both these works, and it sounds like you have,
Very much.
he found the idea of monopoly power and then extraction of wealth from those corporations disgusting, right? So his view was that any business person that just simply extracted wealth for themselves, that was actually that was morally reprehensible. It should be reinvested back in the business, and it should be reinvested back in the business for the purposes of hiring more people. That was his core philosophy.
But his core philosophy was certainly maximize profits
Oh.
in the interest of the shareholders.
His interest was in maximizing profits
That's
with
what
it.
he says in the previous
His interest was in producing profits. But then the question is, what's the use of those profits, right? So the use of those profits is to reinvest back in the business, not to extract for personal wealth. That's his core position, which I think is fundamental.
That's his core position.
Oh, I do. Anyway, but anyway, we can talk more about that. That's how I read it, and there are lots of, whenever anyone writes hundreds and hundreds of pages, there can be some positions that don't really, yes, yeah. But let's talk more afterwards. I love that. So let's think about business education and how that came into play. Because business education arose as this idea of the market economy, right, which did come to predominate, like the American founders were persuaded by Adam Smith and by the other Enlightenment thinkers, right? So when the country was first formed, they very carefully constrained corporations, right? Corporations in the early 1900s, first there were almost no corporations. Most business got done as business as, kind of sole proprietorships, partnerships, that sort of thing. Corporations were very carefully controlled to have a specific public purpose, could only be incorporated in a single state, and lasted for a defined period of time, or else their charter would be revoked and they would be reviewed every 10 years. Over time, corporations got sort of spread. The textile industry was the first one where you began to see corporations form, and then the railroads changed everything, right? Starting in mid-19th century, because they required such scale of investment, right? And you think about railroads, it's a huge capital investment. And as that happened, right, and then after the Civil War, there was pressure to take some of these kind of safeguards and restrictions off, and gradually then as the new industries arose, the oil industry, the steel industry, so forth, now suddenly, and then as the level of concentration rose, the ability to pressure government to take these kind of restrictions off happened, and by the 1880s or 90s, they were mostly gone, right? That companies could incorporate in any state they want, they could own across states, they could live forever, they could be as big as they want, they didn't have to have a public purpose, and so forth, right? And then we arrive at a point where we're probably more familiar, the Gilded Age, right? Kind of the age of the tycoons, where concentration, once again, we kind of went back to the source code, the original mercantilist source code, once again. And this was the origin story of business education, right? This is where business education first came from. It came from the tycoons themselves, right? The tycoons, the original business school in America, there were some schools of commerce in Europe before this, but they were mostly technical schools. Business schools in America were different, right? They were conceived as schools that would provide legitimacy, right, as well as professional skills. They would bestow legitimacy because these large corporations were being railed against, right, in America at that point in time. There were, union protests, riots, the anarchists ran supreme, in the 1880s and 90s. And so the tycoons knew two things. One, that they were going to need to actually make a case for why their corporation should exist from a social legitimacy point of view. And they also needed better ways to train people, managers, right, kind of a new animal called managers, to run their companies. And I'll talk more about that. But Joseph Wharton was Joseph Wharton created the first business school in 1881.
Was Rockefeller?
Rockefeller, University of Chicago, Vanderbilt, Carnegie.
All the robber barons.
Exactly.
But they weren't robber barons. So
Well, they were industrial
they
tycoons.
kept lowering the price.
They kept lowering the price.
Right, and that served the public.
Fair enough. I'm not disputing that.
No, but you make it sound like, there was no public purpose, so the public wasn't served. That's the way your lecture goes, which is just patently false.
I don't think I said that.
No, but without having said what I just said, it appears that way.
Fair enough.
You're telling a story which is entirely one-sided.
Because
market
I
processes lift the masses up from poverty.
no, but what happened in that era was comparable to the social media companies today.
Well, you're going to get to that, I'm sure.
Yeah, I mean it's comparable in the sense
But
that
that's not my story.
you can create In other words, reducing cost, right? Reducing cost is an important social benefit, right? Kind of cost reduction, lower prices, important social benefit. But if it is also the way in which you establish monopoly power, then those two things become commingled and they become problematic socially, which is what happened here and is what's happening now, right?
Whoa, I see. Okay, go on.
No? There wasn't monopoly power?
We have monopoly power in the smartphone business.
Smartphones is, I'm talking about the social media industry.
That's an incredibly valuable stuff. It's become cheaper and cheaper to have
I'm not disputing that. I'm not disputing that. And
automobiles. I mean,
totally.
we have incredible competition there.
Fair enough. Fair enough. I'm not saying that. I'm not saying competition is absent everywhere. It's not, right? But I'm saying where competition becomes absent, it becomes problematic, and that was something Adam Smith deeply believed too.
Every new product comes as a monopoly, doesn't it? I mean, we get Eli Lilly's working on a new drug right now. It's going to come on the market with a product that's going to have monopoly power for a while.
That's called a patent.
Is that a bad idea?
Not necessarily, depending on how it's managed for a period. That's the idea behind a patent, but at some point it goes off
We
patent.
could argue about the length of time, but
We
I
can
think
argue
it's a
about the
great
length of
idea. It
time.
stimulates a new drug.
Totally. I'm not disputing that.
Okay, so okay, go on.
Allow me to continue.
Sure, I'm trying to grasp it.
What I'm saying is that the emergence of large industrial corporations, Standard Oil, controlled 60, 70% of the market at one point in time, right? It was a true monopoly. And those kinds of companies were behind the creation of business schools for two reasons, is what I'm saying. One is because they became very large, and there had never been such large corporate organizations before in the past, and you needed professionally trained people in order to run them, right? It was a new animal, that's Chandler, right? There was a new animal called the manager. And the other is that these people were smart. They knew that if they were going to try to continue their place in the industry, they needed legitimacy. They needed to legitimize the companies as having a viable and useful social purpose beyond low prices for kerosene.
Okay.
So business education then, from the very beginning, had this sort of internal tussle with itself, because business schools were created, as I've just suggested originally, for the purpose of both professional training, but also social legitimacy. That they used language like, those managing business schools should manage for the public good, right? They use language like that. So, we have this sort of constant struggle between the more transactional, it's about getting my ticket punched, get tools, signing bonus, kind of starting salary stuff on the one hand. And then on the other hand, that it's management as a calling, right? That it's a profession, that I want to have purpose, I want to have impact. And business schools and business education have sort of toggled back and forth between these two things since its inception, right? And it continues to this day, right? Where are we today, would you say? Are we more over here? Do people go to business school mainly for this or for this? Right in the middle, right? For you personally, yeah. That's a good thing. That's a good thing. But you get my point. You get my point. And I would say, and perhaps until recently, because I think you're right. I think there is a change happening, right? That especially you guys, kind of you want purpose, right? And and after 30 years or so of business school mainly being about this, it's moving, right? You sense that it's moving. That's part of the reformation that we're going through right now. So this idea then of the rise of business schools, as I've just described, kind of growing out of this era, and the Chandler idea of needing to train, professionally train people, with Wharton, Tuck, HBS, all coming. Tuck and HBS were created in the early 1900s, with Tuck the first graduate degree and Harvard Business School the first MBA in 1908. But the mid to late 19th century was about successful industrialists like Wharton that wanted to professionalize, legitimize, and they taught these skills, right? Bookkeeping, scientific management was a big part, right? Kind of Frederick Taylor's scientific management. But they also wanted to instill a sense of social obligation to the greater good. And you began to have things like AACSB was formed back then in the early 1900s as a certification body. So you begin to see the contours take shape. But then things began to shift, right? That there was the period in the 20s after the First World War. Of course, the First World War there was the progressive era. You had come in and the attempt again to do kind of trust busting and so forth under Teddy Roosevelt and under Woodrow Wilson. First World War sort of took things back to more sort of concentrated industries for war production, and then after the war, the Roaring '20s, which produced huge demand for business education once again, as you might expect. But then the crash came, right, in the late '20s. And starting in the late '20s, then there began to be some serious rethink of what business education should look like, including questioning laissez-faire and some of the underlying logic of what had been the primary industrial logic. And this is where I think another important book comes into play by Adolph Burley and Gardner Means, a book called The Modern Corporation and Private Property. Burley was a Columbia law professor. Means was a Harvard economist. And the two of them kind of co-authored this work right at the kind of the bridge, starting before the crash, but extending into the Great Depression. So they had both of these experiences in their mind as they wrote it. And they didn't necessarily always agree, the two of them. But at the end of the day, they came out with some very interesting positions on what this meant for the management of corporations and capitalism. And I think one of the most important ones is as follows. They concluded, because this was the first time in human history that there existed such large corporations run, because by now the tycoons had pretty much passed on, right? When they were in full force, they had controlling interests of their companies. But by the 30s, they had passed on. The companies were now, the stock for those companies was now entirely in the hands of distributed shareholders. In the old days, it might have been hundreds or thousands, along with the tycoons' controlling interest. But by the 30s, it was hundreds of thousands, right? Even starting in the 20s, right? At least partially the reason for the stock meltdown. A lot of novice investors piling into the market, right, as small investors. So first time you have hundreds of thousands of small shareholders of corporations and professionally trained managers running them for the very first time, right? Neither of these conditions existed in Europe or in Japan, where capital was largely provided by banks still. And so they concluded that this was a unique opportunity, and they concluded exactly the opposite of what the agency theorists concluded. They concluded that we might actually be at the cusp of an age of managerial primacy, that these people have been professionally trained with ethics, and if we put them in charge, they can run these companies in the public interest. This was largely their conclusion, that we've entered the age of managerial primacy. Their terms, the shareholder manages not, right? Shareholders don't manage, right? They can only vote, select board members and so forth. They invest not, they're largely traders, right? They're buying stock that's already on the market. It's secondary trading. Nor do they accept liability. We know that story, right? So if they manage not, invest not, nor do they accept liability, why should they be first in line? Was their conclusion. And they concluded the following. The property owner who invests in a modern corporation so far surrenders his wealth to those in control of the corporation. He has become merely a recipient of the wages of capital. Think about that for a minute. The wages of capital. Such owners have surrendered the right that the corporation should operate in their sole interest. This is exactly the opposite of shareholder primacy, right? Would you agree? And the opposite of agency theory. It's bestowing managers with a sense of purpose, that they can bring purpose to these corporations and manage them for the good of society. Yes, sir?
I'm not going to say anything.
Okay, good. Or not good. We'll talk after. So you see, coming out of the Second World War, companies like GM, which emerged during that earlier era, now being labeled things like generous motors, right? The first company to provide pensions, in part because they could, right? Because the US emerges from the Second World War as clearly the only dominant industrial manufacturing power. Or GE, with Gerald Swope as the CEO, labeling how they run GE as welfare capitalism. His words, right? Welfare capitalism. And again, this is partly because the US was in a pretty unique position in the post-war years because, Germany and Japan and other parts of the world were in ashes, so they could afford to do it. But it's also an interesting indication of just how differently people have thought about capitalism and the management of companies in the past, right? That companies in the 50s, like when I was a kid, right, growing up in the 50s and 60s, the companies certainly had a lot of blind spots, for sure. We didn't like that very much, when it came to things like environment and women and so forth, a lot of blind spots. But their core purpose, they were all about building the middle class, right? They were about promotion ladders, and they were rewarded for that, right? So these companies were run very differently with a different operating system and a different logic. It was a different era, right? Capitalism had been run differently in the past, is my point, right? It had different operating system. And that this operating system then gave way once again to what we have now, right? And the start of that came in the post-war years, starting in the late 50s, because these schools, there was such huge demand, again, in the post-war years with the GI Bill and so forth, they lost their way when it came to quality. So the Ford and Carnegie reports were highly critical. They suggested that professors were more like a bunch of quacks. They would just kind of hire people off the street with no credentials. So they were advocating for research-driven decision science, that the war had been won because of the whiz kids, that we had now quantitative methods like systems analysis and queuing theory and lots of quantitative tools, statistics, survey methods, and so forth that were all honed and helped win the Second World War. And so that was where the quantification of business school really came into play, and the creation of a core curriculum for the first time with a heavy quantitative focus and a functional focus, as we see it today with finance and accounting and marketing and so forth, really emerged in the 60s, and with PhD trained professors, right? They were intent on that. That was kind of the Ford Foundation's primary intent was to make business schools, as they called it, sort of full citizens on university campuses, because they didn't see them as such before. And this, in many ways, was probably a really positive thing. It did, however, set them up, right, in some ways for what was to come. And what was to come as shareholder primacy began to rise in the 70s, as I've already described, was, kind of the financialization of business schools. Where in the 70s and 80s, and I personally witnessed this. I was a wet behind the ears junior faculty member in 1985, at the University of Michigan when I first joined the faculty there. And in retrospect, I was witnessing exactly what I'm describing here, where prior to that, the business schools, there was more equity among the different groups. They were all considered to be equally rigorous, kind of have a more of a, an acceptable point of view with an argument that could be made. But over time, the economics professor in financial economics came to dominate the story in terms of peer review journal publishing, in particular journals, and having a quant theory and quant focus. And this kind of took business schools over entirely, where the aim became increasingly publication in peer-reviewed journals, and other aspects kind of faded more to the background in terms of rewards and incentives. And the shareholder primacy during this period of time then became kind of the gospel as it was integrated into the core. So, we see, the early days of the neoliberals like Hayek and so forth, who, was probably a mild version compared to what came later, but then the theory of the firm, kind of the fuller financialization of markets, got us to the point where I think, if I think about shareholder primacy as a system map, it looks something like this. That there's this sense that maximizing shareholder value is the prime directive, and the way to do that is through quarterly earnings growth as the driver, right? That's the primary metric for establishing stock price. And then you tie executive compensation to stock price, right? And that creates this sort of feedback loop, right? And that's kind of the core cycle of shareholder primacy, as it's still taught in business schools today. But then that means, among other things, perhaps advocating for deregulation and privatization, because that can help boost quarterly earnings, and cutting expenses outsourcing work, cutting worker pay, reducing squeezing supply. These are mechanisms for dropping more to the bottom line and then assigning more of that bottom line to things like dividends and share buybacks, which are now over 90%, in order to drive share value. So it's kind of a reinforcing system at some level, the system of shareholder primacy, which in the end has the effect of widening the wealth divide, at least at some level, because 90% of the stocks are owned by the top 10%. And financial assets are now 5 times GDP, whereas when I was a kid, they were about the same. Widening the income divide, CEO comps 350 times the average worker. You know, when I was a kid, they were maybe 25, 30 times. And externalizing negative impacts, right, in the form of resource extraction, carbon emissions, and so forth. This is, you know, I think this is what shareholder primacy has wrought, right? So this is the world that we're living in now. And unsurprisingly, then, there are countervailing forces, right? There's sort of tribalism and buzzwords, but we see a lot of these kind of buzzwords rearing up. And I know when are we? A little before 4 o'clock. You'll probably find ones that you either love or hate as you look over the map here, but that's the nature, I think, of movements like this, is that they well up from different sources with different kind of motivations, but they all rotate around the same kind of fundamental concern. You know, they just take shape in different ways, and this is what we're living right now. So the question is, have we reached a tipping point? You see more and more books with titles like this, right? Have we reached a tipping point? You know, and here's a book by Peter Georgescu, the former CEO of one of the better known ad firms, where he basically says, for the past 4 decades, capitalism has been slowly committing suicide. Deliver earnings, push up stock price, or perish. Simply put, shareholder primacy has become the kind of cancer that needs to be eradicated before it destroys our way of life. That's pretty strong. That's pretty strong language. But I think for us, you know, here in the business school world, it does raise important questions. Like, does this have real implications for how we go about business education? I personally think it does, right? That ever since the Great Recession, MBA programs in particular have taken a hit, right? We see there was a COVID bump, you know, and there's a little bit of up and down, but overall the trend line is, even among the top 10, top 20 business schools, that applications to the traditional 2-year MBA program are in decline. It's a declining category as we sit here today. And they know it. They know it. For second-tier business schools, it's even more of an existential problem, right? That we're seeing closures of MBA programs, closures of entire business schools. I think we're in one of those kind of yeasty creative destruction times. And, you know, great book by Rakesh Khurana, by the way, if you want to understand the full history of business education. You know, we have things like the PRIME, the Program for Responsible Management Education, and GRLI, and the One Planet Education Network, and so forth. And that's really a big part of what I talk about in my new book as well. I have a chapter on reinventing business education. And what I'd like to do, maybe if we have perhaps 5-10 minutes? Okay, because I realize it's 4 o'clock.
It's fine.
Okay.
And some people have to leave first.
Yeah, and that's fine. That's fine. I wanted to say just a couple of things about, you know, what we've tried to do at the University of Vermont with this new program, which I think is an attempt on our part to reinvent the MBA, reinvent business education. But I thought this little quote from Louis Brandeis was especially pertinent, you know, that in the field of modern business, so rich an opportunity for the exercise of man's finest and most varied mental faculties and moral qualities, mere money-making can't be regarded as the legitimate end. You know, I just think that's so on target. Like, why is it that we have some of the smartest people going after one simple-minded objective when they could be accomplishing so many others, right? That it's an optimization game, not necessarily a maximization game. So what we tried to do with our program at Vermont is to get beyond just kind of incrementalism, you know, that we use the metaphor of saddlebags, you know, that so much of what's happened at business schools so far when it comes to these issues is you have a few electives, you know, in the second year, maybe you stand up a center, get a donor to give some money, and I'm guilty as charged. That's what I've been doing for the last 25 or 30 years. Create a center for sustainable business, you know, do applied research, work with companies, couple of elective courses, but then the core is still the same old core, right? That is bringing kind of the shareholder primacy perspective home, and that's what people really leave with. So we were motivated, Sanjay Sharma, the dean at the University of Vermont. He went there with this express intent to do this. His first official act when he became the dean at the University of Vermont was to abolish the existing MBA program, which wasn't very good, I'll have to say, and he, by his own admission, is why it was so easy to abolish, right? It was kind of losing money, shrinking, so he didn't get a lot of pushback. And that opened the door for us to start over again with a clean sheet of paper, to literally kind of genetically engineer a new horse. That's what we sought out to do. To reinvent business education, develop a new generation of leaders who will transform capitalism, to solve the world's most pressing sustainability challenges. So, we, from the beginning, really didn't care that much about the traditional MBA rankings, like Business Week or US News and World Report, because they're all just about how much more money people make after they graduate, because you got to service your debt, right? So one of the things we did was dramatically drop tuition, since that's a trap, kind of the debt trap is a real problem. But we pay attention to things like, the Better World MBA ranking, Corporate Knights ranking, which people look at increasingly. So there are more and more purpose-driven people, right, who are looking for this kind of thing. And we're accredited. It was easy to get accreditation because ACSB is actually trying to pull more business schools in this direction, right? Am I right, Dean? I mean, it's not like they're saying, this is a bad idea or this is a commie plot, right? They're trying to pull more business schools in this direction. So here's what we did. We recognized that you have to have, the core MBA functional toolkit. You have to have that, right? There's no getting around that. But you can teach it from a critical perspective, right? Like when you teach finance or marketing or strategy, I'm a strategy professor, why not ask the question, like, what are the toxic side effects of using this tool? Like what, right? So everything solves problems but creates new ones. What does using this tool, what damage could it potentially do? What's missing from our analysis? Should we have other tools that could consider other elements? That we can teach these things from a critical perspective and not just as gospel. And one way to make room is starting over again, right? We were able, because we started with a clean sheet, it's like zero-based budgeting. There's a lot of stuff in MBA core courses, because I taught the core strategy class at Michigan, UNC, and Cornell. Not just in the strategy core course, but every core course. It's there just because it's always been there, right? It's always been there. It's easy, the notes get passed down, professors just keep teaching the same thing because it's easy, right? We're all the same, right? And from that point of view. They got more other priorities like getting their articles published. But if you start over again, you can literally jettison a lot of what really is kind of vestigial content. Like in the ops core, for example, it's typical to have 3 weeks or so on queuing theory with hand calculations. I'm not sure how necessary that is. Like, do you need to know what queuing theory is? Yeah, you can learn it in 15 minutes. Then you would need to know where to go if that was ever an issue for you. You probably don't need to do hand calculations, right, of optimizing the line. So we're able to kind of remove a lot of legacy content while still kind of keeping a critical perspective around the core toolkit and then bringing in a lot of new and different content that you would just typically not find in an MBA program at all because it's going to be important to to this century that we're living in. And then we have a practicum, that's the capstone. It's a 12-month program. All the courses, as you'll see, are short, right? They're all 1 and 2 credit classes. Here's just kind of a list of some of the courses. And we did that on purpose because by making them 1 and 2 credit classes, a faculty member couldn't just take their existing syllabus and put a new title on it and say it was, right? I mean, a common trick. So if you actually change it from 3 to 2 credits or 1.5 to 1 credit, you actually have to redo the syllabus. It's kind of, so it forces some thinking. We built up a faculty team that co-designed this. We kind of storyboarded the whole thing so you could see what the flow of the program was over the course of the 12-month program. Yeah.
Along with this?
Yeah, good question.
Yeah.
I was intimately involved in this.
Okay.
Yeah, it was both challenging, but also easier than I thought. Right,
Okay.
the problem wasn't so much getting faculty from the school that were interested in, because this was sort of like a new thing. There was some financial incentive built in, like some summer support to get involved. Right, so that helps too. Right. The bigger problem was that we didn't have the faculty in the school they couldn't teach a lot of this content, right? So they just didn't know it. So yeah, so we had to reach outside. We brought in people from outside, right, to be adjunct professors, that sort of thing, at least in the early going, and then combine them together. It's like building the bridge as you walk on it. You'd have to design something that you can actually teach. So availability of people to actually deliver influence what you end up doing, you know, and vice versa. So these things kind of go together, right? But in the end, we ended up with a faculty team that understood the whole program from top to bottom, and it changed the way they thought, right? They learned a lot about this, and it changed their thinking even about their function, right? And in some cases, it changed the research questions they asked.
Feel like a class.
Exactly. And they felt more self-confident, because a lot of the reasons why professors don't want to talk about this stuff is because they don't really know that much about it. And they don't want to look stupid. Nobody wants to look stupid, right? So this was, I think, a really interesting experience. And we discovered that, yeah, the curricular innovation is a really important piece of it, but in some ways that's just the beginning. Where do you find the right people for a program like this? And one of the things we discovered was there's a whole ballroom of prospective students out there that don't know they want to go to business school. Like half of the students that are now in our program weren't originally thinking about business school. They were thinking about design school or environment school or law school or policy school. They knew they wanted to do something positive in the world, and they weren't sure business school was the place. But this kind of changed their thinking about it. So half of our students weren't originally thinking about business school, which means there's a whole new, kind of ballroom of prospective business school students. That should actually be, really heartening. But then most importantly, I think, is what happens after you graduate, right? You're still coming to business school because you expect to do something positive out in the world and get paid for it, right? There's no question about that. So we've been, for the last 4 or 5 years, trying to develop this downstream approach we call launch, not placement. In other words, the culture of the program isn't come, pass through the courses, like there used to be an old slogan at Michigan back in the old days when we gave letter grades, 90 G's for 20 B's. Don't just go through the motions to get the course so you get your ticket punched, and then get the high-paying job. But rather, launch isn't, so it's not just traditional placement where you get offers in your lap. You have to come as an entrepreneur where, we're going to work with you to kind of build your network out there in the world in the kinds of companies or in the kinds of ventures that you feel as though you can contribute to, but then you have to actually go out and make it happen, right? So we have a launch system that enables people to kind of figure out who their best self is, what they want their next step to be, and then inject them into the right network, train them in terms of interviewing, informational interviewing, resume development, and so forth. But then they have to be hunters, right, as opposed to passive recipients of jobs. That turns out to be a really important thing culturally. So, and I'll finish up here. In terms of the kinds of roles, right, that most, I would say, conventional 2-year MBA programs focus on placement into these kinds of jobs, kind of established companies in marketing, finance, operations, consulting, and on Wall Street, of course, kind of probably the biggest one, but sort of implementers that typically would be paid to continue the current strategy, by and large. Our focus has been on, kind of the startup space, and, where we're looking, to be more change makers, entrepreneurs out of new business models in the clean tech and inclusive business space. For our students either becoming entrepreneurs, and we've had about 5 startup companies come out of the program, but also joining these kinds of ventures, and the investors into that space, kind of the impact investing space. And then on the other end, those established companies that have realized their days are numbered and are looking to transform. It's about new business models, transformation. It's the same thing, right? But it's being a change maker within existing large corporations, and the consulting that goes along with that. That's what we think we best prepare people for with the program. So, I think we have an interesting curriculum. It needs to be continuously improved. It's accredited. It's a 1-year, it's not a 2-year opportunity cost. It's 9 months and then a 3-month full-time in-venture in company practicum. And then, as I say, we priced it, it's 1/3 the cost of a traditional 2-year MBA. So you have a lot more degrees of freedom when you're done. And I think a combination of these things makes a difference. So let me stop there and just say, one little program like this is cool, but it doesn't really get us very far, right? The objective is we need to be disruptors in the business education space because, in my view, within the next decade or two, the MBA as we know it has to be creatively destroyed and reinvented. We have to get to the next stage of capitalism. And that's really, we must create a larger initiative to play a significant role. And net impact, for example, increasingly, if you guys know net impact, is looking for that to become their role for the future, kind of to play that catalytic role. Let me stop there, because I realize I've gone over already. Thank you for bearing with me. We can have a little more conversation.
All right, thank you. I'm going to ask Stu a few questions. Could you pass your orange cards in to the front while I just ask him a couple of questions? So Stu, you've been standing.
Absolutely.
Have a seat. So, no, we're not done. We're not done. We're not done. Stay.
Or they're free to leave.
So, as I said at the very beginning, I said that Stu had created two companies. And I wanted to ask Stu to tell us a little bit about those companies.
Yeah.
Organizations.
Yeah, so one is this little, I started a nonprofit consulting firm called Enterprise for a Sustainable World, where we mostly work with companies on the kinds of transformations that I've just been describing. And and we've had some, I think, reasonable measure of success in doing that. Have worked, and I know we'll talk a little bit more about perhaps a single initiative. But that's one of them. And that kind of comes and goes. I don't depend on it, nor do the people that are involved. It's sort of like it's a vessel through which we can do good work with companies when the opportunities arise, but I don't need the money, right? I mean, it's really more purpose-driven. And the other is something called the Base of the Pyramid Global Network. And what that's about is, so 20 years ago or so, as I was working on this stuff, and you mentioned I mentioned the Beyond Greening article that I did. The idea of beyond greening versus greening. Greening is all about kind of incrementalism. It's eco-efficiency in current facilities. It's product stewardship in current products, and that's great as far as kind of continuously improving the current business. But every company needs to be inventing tomorrow's products and markets at the same time. If all you do is continuously improve current assets, eventually you fly the plane into the ground, right? So there has to be a beyond greening piece, which would have to do with getting to tomorrow's technology, not just reducing the negative impact in current product systems, which are often based on inherently unsustainable technologies, but rather innovating and leapfrogging into tomorrow's technology, whatever it might be in whatever sector you're in, and creating commercially viable models to do that. And then the other piece has to do with where those future markets might be. And that was where the work came in, focused on the underserved. That so much of corporations and capitalism for the last 30, 40 years have assumed that kind of capitalism and corporations are primarily for the rich, because that's where the money is. And we can go after the top of the market, and that's where the best margins are. Maybe it'll trickle down over time, sort of the Tesla strategy. But then, there's 2/3 of humanity who have fundamentally been left behind, when it comes to this. And you can't just say, well, that's government's problem or that's the NGO's problem. It's like a division of labor. And so we were motivated, and I wrote a piece with a professor at Michigan by the name of C.K. Prahalad, now about 20 years ago, the title was provocative, The Fortune at the Bottom of the Pyramid, which sounds like we're just out to raid their money. But that wasn't what it was all about at all. It was about thinking creatively about how we can co-create new businesses and business models that serve and lift the underserved and make money doing it. You have to be profitable, right? There's no business unless you're profitable. Profit is a requirement, but it's not the purpose. So we developed a whole set of tools around the idea of co-creating businesses in underserved communities at the base of the pyramid, and then started hosting these meetings with people from companies who found this is 20 years ago, found this idea compelling, right? And it was only a few people at the time, and they started coming from all over the world. And we were kind of shocked and pleasantly surprised by that. And then we started having it once a year, twice a year, 3 times a year. And then we realized people would go back and they would start these kind of because it was like sharing experiences and how to go about this within their company or in their venture. Then they would start similar kind of learning labs back home in Europe, in Africa, in Latin America, and Asia. And by the time it got to be like 2010, 2011, 2012, there were like 15 of these things that just kind of spontaneously had created themselves. And so we were doing a bunch of work in Brazil at the time, and the company Natura, if people know Natura, gave us a grant to create a base of the pyramid global network where we were able to kind of link all of those labs and learning centers together so they communicate with each other and share learnings, and then also kind of bring their findings, tools, techniques, and methods to the fore. And so we've been able to publish several edited books that are kind of tools, techniques, experience that come from the ground, in these different geographies. And then every couple of years we hold a global summit called the BOP Global Network Summit. And so that's really more of a network organization. It doesn't require a big centralized, it's really being more of an orchestrator.
But this has really helped translate all this thought.
Yeah.
And transmit it from across many countries. Thank you so much. Any more? All right, so I am going to pick the first question. All right, here we go. Bring it up, bring it forward, John. Oh, that's a cute one. Somebody just drew a picture.
Nice.
All right. This is from a student. What ways do you see Simba changing in the short and long term? This
Great.
is Chloe. Is Chloe here?
Yeah, that's me.
That's you. Chloe, you get a book.
Yeah. And it's a great question. I appreciate that.
Yeah.
Yeah, I mean, this is actually, again, passage of time is a strange thing, but the cohort that's in the program now is the 10th cohort. So it's like 10 years of the program already. So the design is 10 years old, and we've done, continuous improvements. Some things obviously have happened over the last 10 years that require that you bring new content into the program and so forth. And we've tried to do that, in terms of the evolution of a lot more quantitative tools in, company ratings, ESG ratings, and in a lot of the, reporting requirements that are coming down the pike. So we've tried to roll in additional content as it's evolved. But I think as I sit here today, and we were actually talking about this right before the session, it's probably time, the typical response would be, well, nothing, we're sailing along, right? Our applications are increasing, not decreasing. We're doing something right. Most of your MBA programs applications are decreasing. But I don't think that's the way we would want to look at it. I think it's a 10-year-old model at this point, and we've got some failure points. So I'm of a mind that it's time for us to do probably a reboot of the whole program, because when we first designed it, we brought in advisors from the outside. We had an advisory council, right, of both people from companies, from NGOs, and from academia, as we were kind of designing it along with this kind of faculty team that we were trying to build. And that had a certain perspective. And I think as we look out now 10 years later, we've obviously missed on some things. Probably the major one being we're in Vermont. That's no excuse. We're attracting Africans. We're not attracting African Americans. And so rather than saying, we need to just dangle money or, try to get more people to come to Vermont, it's obviously a failing in our content. So we need to actually kind of take a careful look at ourselves, involve some new and different voices in what we're doing, and redesign our program again, because I don't think that can continue going forward. And there are some other, I think, pinch points that way, that after 10 years you realize we kind of missed it on a few things. And rather than just trying to shovel it under the rug, I think you do a reboot, which is where we are. But I appreciate that question.
Okay, here's another great question. This is from Owen. There are so many cards that I don't have a name. Owen, yes. This is yours. So where do you think specialized MS programs fit in your model instead of just MBA?
Yeah. I mean, I think it's all the above. I think specialized master's programs, right? Yeah. You talk about specialized master's programs. I think they're great, and especially if because they can be laser focused, right, on a particular direction you want to go employment-wise. So I think all that's great. The reason we felt it was so important, to focus on an MBA program, because our motivation was to try to create a model for shifting MBA writ large, right? And for it to be accredited, right? Because you see, the original kind of we'll call it sort of next generation MBA was Presidio, right, out on the West Coast. And there's also a, quote, sustainable MBA at Bard in New York. Neither of those are business school based. Neither of those are accredited. So we thought it was important to stand up a new MBA program that's in a business school that's AACSB accredited to demonstrate that you could do that, right? And that not only was it possible to do, but that it could actually succeed, that it could grow, that it could attract more students, to demonstrate that it's possible to do this, and that it's not just some pipe dream. And then, we've been working with several other schools over the last several years, some of whom, have begun to go down this path, right? I'll call it it's really starting over again, right? It's not saddlebag, right? It's new horse. And there are a handful of other business schools at this point that have gone down that path, right? To create an entirely new MBA program. And probably unsurprisingly, it's happening first in the so-called second tier. Right? It's not happening at Michigan or Cornell or places like they're incumbents, they're industry incumbents. They've got big established MBA programs that are cash cows. Although the conversation there has even begun, right? Because even the deans of those schools realize that the jig is up when it comes to that the days are numbered on the current model, right? It's just that big incumbents are usually the last to change, right? So, if you know Clayton Christensen's theory of disruptive innovation, usually comes from the bottom up. So I think we get more and more of those kind of programs to demonstrate the viability of this and that they're growing. That's a pretty strong signal to the industry.
Thank you. So here's another one, and this is from Isaac Rogers. He's got two that are really great. You mentioned a lot about MBA programs. What about undergrad programs?
Yeah, totally. Yeah, I mean, it's, yes. I mean, the business education is a large edifice, right? It's not just MBAs. We obviously chose the MBA for strategic reasons, and I've just sort of stated, the case why that would be. Undergrad obviously involves more students, right? I mean, it's a much bigger audience, right? And potentially, maybe even bigger impact because younger, more time out in the field, and so forth. And so our experience, I can relate the experience at Vermont because I think it's somewhat instructive. So I don't think Sanjay would mind, our dean, what I'm about to say. But 10 years ago, the university, I told him when he went there as dean I think he went in 2011. He told me he was thinking about taking the dean job at the University of Vermont at the business school. And I had to confess, I didn't know they had a business school, right? So it's a place where it didn't have a lot of rep. It wasn't really well known. It was kind of a regional play at best. Maybe, it was Vermont, but then maybe it was second choice for people from Boston or New York or what have you. By really targeting the MBA program, we were able to build kind of reputation, right? The place is known now, right? People know about the University of Vermont Grossman School because that's where the Sustainable Innovation MBA program. We've been able to attract faculty to the school because of that are coming because they're interested in SIMBA and that's their research bent. So over the last 10 years, it's only about 40 faculty, it's a small school. We've added 10 faculty off that base of 40 over the last 10 years, and all of them came because of this, right? So they bring more knowledge and experience. All of those people are teaching in the undergrad program, right? So one way you shift it is by attracting more faculty with this as a kind of key expertise and interest, and then a big part of their teaching load is in the undergrad program, and then lo and behold, the structure of it starts to change too, because they're all on committees, right, in terms of the design of the undergrad program and the improvement of the undergrad program. So at Vermont, the undergrad program has actually structurally changed in the last 10 years to include, kind of one of the legs of the stool now is sustainable business. And that just wasn't the case 10 years ago.
Great. Here's question number 2. After being in this market for so long, what would incentivize CEOs to go back to making just 25 times the average worker's pay? Would it need to be initiated by workers? Another solution? What do you think?
Lots of good questions. Lots of good questions. I think at the end of the day, it really comes down to a mindset, right? Typical of eras, and you can sort of think of this, what I've just described, the different types of capitalism that I described, like mercantile capitalism and market capitalism and, industrial monopoly capitalism and welfare capitalism, now shareholder capitalism, are sort of self-sealing systems when you think about it. They're regimes of thought and mindset as much as they kind of actual practice. And that's not the way CEOs thought, 60, 70 years ago. That wasn't part of their motivation. It just wasn't part of the mindset. Were they interested in making being fairly comped, making good, of course they were, right? Were they interested in profit? Of course they were, right? But it assumed a different place, in the pantheon. And I think we're at that point again where you already begin to see the seeds of that, right? I mean, you see things like, the B Lab and the B Corp begin to well up, right? Where actually that concern about CEO pay is structured into, you can't be a B Corp, right? If you have that kind of wage difference. There has to be demonstration of living wage to workers as well. So you begin to see these kinds of new forms kind of well up, usually starting from the bottom up, right? That's the way these changes typically happen. And then eventually, I think that the aim is you get to a new sort of era or age which combines both the economic and the political dimension such that capitalism is committed in a different way, and then people's managerial mindset shifts. And if we can shift business education, I believe that's one of the this is a lever for changing the way people think about business. As it is now, we're sending people out into the world that are brainwashed with shareholder primacy. That has to change.
All right, thank you very much. Alan Yen? All right. Question?
The question I was hoping to ask in person is like, you talk about all these changes in terms of this education, things like that, and that was based on the assumption that people agree there's a purpose to pursue that education. But that is still kind of like a niche group right now. How can you really spread that kind of ideas to the general public that we should all find a purpose in life and actually pursue a business education like this, therefore we can do more good? Because most of the times, as a faculty, you see that students sometimes when they enroll in a program, they don't know about all the details until the end of the program. Now that's what's going on.
Yeah.
So how can we really kind of approach that even before they join the program says, aha, this is the program that we should pursue because that can really help me to do better things to the society.
Yeah. Again, great question. Let me answer it with a story, and it's based on research that was done by a professor and a doctoral student at Michigan, and believe me, it's relevant. They were sort of interested in the same question, like why is it that if you look at graduating MBA students, virtually the lion's share of them are motivated primarily by competing for the best jobs with their peers in a select few kind of high-profile consulting firms and so forth. How does that how does that happen? So they were actually motivated to try to study cross-sectionally over time, longitudinally, how MBA students think from the time they're admitted to the school until the time they leave. And so they would collect data at different points, like right after the admission decision, when they arrive on campus, there were interviews about kind of what attracted you, what motivated you, what are you thinking, those kinds of questions. And then at the end of the core, right after the first year, just before the internship, after they come back from the internship to start the second year, and then starting the second semester of the second year, because then it's basically over, right? They've already got the job offer. And what they found was probably not surprising, but I think kind of sobering at the same time, that the admitted students to business school on the front end, when they're first admitted, when they first arrive on campus, the vast majority of them say they're coming to business school because they want to get skilled up and learn how they can have the most positive impact on the world, blah, 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 blah. That's what they say, right? That's why they're coming to business school. And then you watch the kind of the nature of their response change and evolve over time. By the end of the core, they've already begun to change their story, right? Then it has more to do with, the shareholder primacy view has been pretty much put in place by then, and it's about getting the best internship, and then once they're done with the first year and off onto the internship, then when they come back, it's all about competing for the job offer, right? And that should I go to A.T. Kearney's okay, but I mean, like my best friend just got an offer from Booz or from McKinsey, and I don't, that's what's consuming them at that point in time, and that's pretty much the story. By the time they graduate, any idea that they came to business school because they were motivated to try to do something positive in the world was gone. So I think a lot of it is not so much the initial motivation of people wanting to come as it is what they learn. Right? So I think if we can shift what a business education actually means to allow people to realize their original intentions, that's all it takes.
Thank you.
Thank you so much. It is 4:30, so I think it's time that we move to the reception and have all of the questions one with Stuart. But thank you so much for coming. Thank you, Stu. It was awesome.
Thank you.